Hello, finance students. So this will start our week one lecture, and just here's a plan for the next little bit we'll spend together. So the first agenda item is to understand the calculation of operating cash flow. So this is the cash flow that you would see on an income statement. So we'll go through a few of the different items that affect the ultimate calculation of earnings, and work through some examples of getting to those numbers. And it's important to understand that process well because occasionally we'll run into a situation where maybe we know the answer but we don't know the question, right? If we know earnings but we don't necessarily know EBIT, we might need to work backwards, which can involve some simple algebra. And so it's good to understand the basic steps. It's not particularly complicated. It's we start with revenue and subtract off expenses essentially, but there's a couple different important aspects, I guess, to that process. So that's what we'll do in part one. And we'll take a break, and I'll come back in part two, and we'll talk about financial statements. So not just making them, but reading them. So how do we interpret what's on there? And traditionally, the way we interpret financial statements is to use ratios, generally because companies are of different sizes. And so, if one company makes $10 million and another company makes $11 million, we don't necessarily know that the 11 is better, because the $10 million could be a $20 million company and the $11 million could be a $1 billion company. And I would much rather make 10 on 20 than 11 on 1,000. And so in order to make these two different entities comparable, we typically divide by some kind of scale parameter, like scale or sales or assets, inventory, accounts receivable, some kind of measure of the size of the operation. And then in the numerator, we look at some kind of generally positive quantity of interest, like sales or income or potentially cost of goods sold, which normally we wouldn't think of cost of goods sold as a positive, but it actually is if it means you're selling, right? If I have to turn over my inventory and buy more inventory, it means my business is operating. So we'll talk about ratios interpreting financial statements in the second part. So just as a general introduction to the big picture on cash flow. So what we want to do is translate revenue into some kind of meaningful profit measure. And ultimately our goal is to think about doing capital budgeting. So if I have a proposal to do a new factory with e-ink infused clothing, that's the precursor to your that's the problem of your project you'll face in 3 or 4 weeks. So we obviously, doing a new production facility with unique equipment is going to take some investment, right? So we have to decide, is the investment going to produce the returns that it needs to given the risk? And that means we need to estimate revenues created by the project and profits. And so if I have forecasted revenues, I can predict the revenues that the project will generate, and then subtract off the relevant expenses by being reasonable about what it would cost to produce the goods. So that's kind of the general map is for finding the profit for a year is revenue minus expenses, but expenses take on a couple different types. So we have variable cost, which would be a cost of goods sold. If this was if we're making a widget of some kind, It could be cost of sales if we have a service business. For example, if I'm Hertz Rent-A-Car, I don't have cost of goods sold because I'm not transferring ownership of anything. I have a rental company, but I do have a cost of sale, right? Every time I make a sale, I have to pay a desk clerk. I have to turn over the car, right? There are costs to doing this. So different industries will have different costs associated with them. If you're a bank making home loans, the factored into the cost of your mortgages are the cost of the financing for the mortgages. Right? If you're accepting deposits and paying interest on the deposits, then that's a cost to you. So variable costs are the kind of costs that scale up with sales. So, inventory is an obvious example where if I sell twice as much, I have to buy twice as much inventory. Or a service business, the cost of the employee performing the service should scale with sales. But not all costs do. So, for example, if I am a law firm and I have a $6,500 a month office space, if I increase my revenue and do more business, that won't necessarily increase my rent right away. If I have space to grow into, it won't affect it at all. Maybe I can change the space to be more efficient, or maybe I run out of space and I have to scale up to twice that. So it doesn't move smoothly with sales, and so it might get stuck somewhere else. We also do consider things like patents. So if I am manufacturing a product that requires a patent license, we might buy that up front, and then the cost of that patent license is independent of the number of sales. So things of that nature will be in fixed costs. And it's all costs, right? It's all expenses just coming off revenue, but it's important to make the separation so that we can distinguish between the types of expenses we're facing. And the next important category of expenses is depreciation. So depreciation measures the breakage on capital equipment. That's the simplest case of depreciation. So if I buy a machine to make Oktoberfest buttons, this will be the example we'll work with. So I have a button press, and I pay $20,000 for my significant button making machine. There's a presumption that over time, eventually this machine will break and will be unusable. And in the accounting, what we do typically is treat some fraction of the value of the machine as reducing each year. And so we need to account for that loss into our measure of the profits, because otherwise, if I take $20,000, buy the machine, make $10,000 in profits, and then have to replace the machine for 20, I'm falling behind, right? This is not making money. So we need to measure the capital equipment cost of what we're doing, and depreciation is how that's done under GAAP. The next major category of expenses is interest. Now you see I've got an asterisk there. Interest is somewhat contentious to include, and the reason is that it's not really an operating expense, it's a finance expense. And lots of different sources of financing have expense. If I use equity financing, they'll expect dividend payments. And if I have an investor that has a royalty on the sale of my asset, I will make royalty payments. Those kind of payments are not included here, but interest is. It's to some degree kind of a historical accident, or maybe a logical consequence of way income is calculated for tax purposes. And so actually there is a difference between books on this issue. So our text includes interest in the calculation of net income, which I would describe as the accounting approach. This is how it's done for tax purposes. This is how it's done under GAAP. Many finance books will exclude interest. That means that the net income calculated differs from the net income that would be true under GAAP, under generally accepted accounting principles, but better reflects the true operating income. And then the interest and the tax effective interest are calculated when considering the cost of capital. My preference is to not include interest, but since our book includes interest and the exercises will use interest, then we will subtract interest for this class. Lastly, we have taxes. So taxes are last because we need to, we're taxed on profits, and so we need to eliminate all the other expenses first and then eliminate tax. And then lastly, we add back depreciation when calculating cash flow. So taxes is the last step for accounting earnings. That's our best measure of value generated by the process. But we add back depreciation because to get cash flow, because we might have more cash than the earnings we made. And this seems kind of counterintuitive, but really what's happening is if I'm not paying for maintenance, right? If I'm not setting aside money to replace my capital equipment that's breaking, I can be accumulating money, but that doesn't necessarily mean that it's not pledged, right? So the cash is piling up, but it's going to be spent whenever the machine breaks. And so it's good to know both numbers. We want to know how much money we actually made and how much money is flowing into the cash account. Because businesses can die both ways. If you're not profitable, no one will want to invest and your business will slowly die. And if you have negative cash flow, you'll run out of money in the bank and you'll die that way too. And it's very, very possible to have positive cash flows and negative profits, and to have positive profits and negative cash flows. I mean, a great example is Groupon. For a long time, Groupon lost money on every sale, but generated a ton of cash with every sale because they would keep the proceeds from the sale of the Groupon and return them only after the customer had actually used the Groupon rather than the date of purchase. And even then, it was something like 30 days. And so they got to sit on the money for a while, which, in a steady business, that nets out to nothing. But Groupon was not a steady business. It was growing fantastically fast. And so the cash rapidly piled up. So that's kind of just a broad map. So let's take a look at these pieces individually in the next segment.